In this section, we will cover the topic of how to use the ladder of the depths of market for a better execution, which will give us a better risk control and maximizing our profit. Our discussion today will be focused on the NASDAQ as a thin tradable future product. The same idea applies to many products, but not with the same behavior. The basics are the same, but the behavior are slightly different from one product to one product. But I'm focused here on the NASDAQ because it's the easiest to read, and it's the thinnest market between all indices in futures. And we will talk about today walls, liquidity, and round numbers. So when you executing your trades, usually most traders execute from the chart, and they put the orders on the charts as entries and stop loss and take profits and so on. But executing on the ladder probably harder than the chart, but once you get used to it, you can never look back at trading from the chart. Why? Because the ladder is the source of information that where it flows into the chart and volume profile and other indicators if you're using any indicators. So the source of all information is the ladder, the dome, where you can see the buyers and sellers interacting with the market you're trading in. So the first thing we let's break this down before we start looking at these examples above. This is the ladder, as we know, prices in the middle, the bid and limit order for buyers on the left side, and the ask here, the seller's limit orders. So we can see the market orders interactions pushing the prices up and down between these limit orders. So for you to have a better execution on any of the setups we talked about before, you have to marry your ladder reading with this setup in order to have a better execution, a better entry, 1-2 cents better entry than the one you usually takes, because the ladder will give you that vision and exposure to the buyers and sellers where you can take the best buying price or best shorting price, the perfect place to exit and where to scale. So we will be talking about all of these things. First, the round numbers. As you can see here on the ladder, you see the NASDAQ standing at a price 11,626. First thing we need to know how to interact around round number prices. So basically round number prices like 10, 15, 20, 25. These are we call the round numbers. So 11,625 here is a round number. We can see here, this is the only one we see so far on the example over here. Let's look at a wider example. We have 11,880, that's a round number. 875 is a round number, and so on and so forth. You get the idea. You get the idea. So the first thing we need to know, trading around round numbers, first we need to see the levels and values first, and then we need to see structure, and then we need to see a setup that tells us where the market wants to go. And then I tend to interact with the market trying to catch the best price to buy or short. So how can we use the round numbers to buy or short? The round numbers are usually a liquid prices within the very, very small frame, because this is where hedge funds and big institutions like to interact with the market and enter big orders. So usually these round numbers offers liquidity. So when you want to enter a trade around round number, for example, let's take the 25 as a round number, 11,000 something and 25. The best prices to buy around this round number is below it, let's say 24. And the best place to short around round number is 26. So always above the round number, we can take the best short opportunity entry. And below the round number, let's say the 24, we can take the best buy opportunity. Why? Because we are expecting the market to act like this around the round number. So why do you enter at the round number if you know that the market will range between 26 and 24? I know that there will be a couple of ticks in between those, could be in my favor if I can take a better entry. So if we are looking at a buying, it's better to buy at 24, between 24 and 25. And if I want to short, it's best to short between 26 and 25. Keep that round number in your direction, in your favor, always. That will give you a couple of cents or a couple of ticks in your favor. When these couple of ticks accumulate on 100 trades, it's magic. It will show you a better performance on the long term always. So the first thing, trading around numbers, so pay attention to those. The second topic is a wall. Now we tend to jump to the limit orders visible on your ladder at the moment you're trading. So we have two forms of a wall. What are these two forms? The first form is an LVN on the limit orders showing like this. This is an LVN where you can see orders 3 and 4 and 5, and then suddenly you see 2 and 2, and then 5 and 4 and 3. So you will see your ladder showing like this, and then like this, and then suddenly you see a drop in the limit orders, and then another orders again. This area, this is what we call a wall. What do I mean a wall? A wall is not a strategy. It's a visual interaction in the market that you can see on the ladder, but you can use it in your favor as a tool. The wall behavior always rejects price. So I can use these walls to protect my stop losses, or if I want to short, for example, if I want to short, let's say down here, and I have a wall in my way, you better wait till this wall gets broken first by the price action, and then you can enter, because these walls act like literally a wall in the prices, in the price fluctuation. So if you want to buy, if you want to buy this behavior, for example, here, I bought over here. Let's not talk about this example because I've already taken the trade here. Let's explain things on the side first. So if I want to buy, I take a buy, and I have a wall behind me, a LVN on the ladder, which represents like this. If I have this behind my buy and the market price action came, executed my order and start moving my way, and I have a wall over here, that wall could be very good place to protect my stop loss. So I go and place my stop loss just below this wall. It's a better place to save, protect your stop loss, because if the market came, took this wall out and took your stop loss, then the wall is broken and the trade is not valid anymore. So this is the first use of a wall. How also we can use a wall in our favor if we want to short. In the same example, if I want to short and I have a strong wall like this in my way, like this one over here, you better wait for the wall to get broken first, because it might prevent the price action to move below it and it will revert against me. So I have, if I want to short, I have to see the wall in my favor broken first. So that's the wall. This is how we can use it as a tool in our favor, which if it's in our favor or against us. The second type of wall basically looks like this. Over here on the left, it looks like a head and shoulder sideways. Big order in the middle and two small orders in between. And this wall looks like this. And you can see the letters interacting, but you can see this wall and you can use it as a wall. to protect your stop loss, or wait for it to break if it's standing on your way of the trade. So pay attention to these type of walls, this one and this one. And when you see that, you only pay attention when you have the setups and the values and everything structured on your chart. Wait for the setups, wait for the market to decide a direction. Before anticipating the trade, shift your eye focus on the ladder and try to interact with these walls to get the best entries, the round numbers and the walls. The last thing I will talk about in this section is the liquidity. The liquidity is the opposite of a wall. Means if you have, I'll have an example here. Liquidity. Liquidity is a big order on the limit bid or ask. So for example, you see this 15 over here. This is a liquidity standing on the ladder. This liquidity being visual, you be able to see this liquidity on the ladder. Same thing like walls, you can use it as a tool. This liquidity I can summarize, just to summarize, it could be the hunter or the prey. What do I mean by a hunter or a prey? When you see a liquidity in your favor of your trade, let's say I took a short over here and I put my stop loss over here. So I'm expecting the market to move down. When you see the market offering big liquidity, that means that the sellers are on your side of the trade, and these sellers have big size to sell, and they will seek liquidity on the ladder. They will seek a prey. They will seek someone to sell to without pushing the price further down. Because if they find enough liquidity, they don't have to sell and lose money on averaging down. So liquidity for a big seller is opportunity. And if you are on the same side of this seller, he will push the price down for you all the way to this liquidity. So when you see liquidity, keep an eye on it and put in mind that the market, if it's moving against the value, it will tend to go and attack this liquidity as a prey. It's a prey. A buy limit order liquidity is a prey for the sellers or the sellers. Same thing on the opposite side. But here's the thing. In case if this liquidity is a hunter, that means if we see the price moving against liquidity, of course, let's say now the liquidity is above you. We have here an order of 20, for example, and all other orders are from 1 to 10. So if you have the liquidity, you enter a trade short, and you have a liquidity, you have to pay attention to this liquidity because probably this guy is a hunter. No buyers are able to push the price up and take this liquidity. That means this limit order is now a seller hand showing in the market, and we tend to use this liquidity to protect our stop losses. So you have to be able to identify if the liquidity in your favor and it's a prey, or if it's against you and it's a hunter and it's someone that pushing the market down, the prices cannot push against. And I know there is a lot of technicals here and you might get confused. So let's take an example. Let's take an example. Just a second. So I have a lot of data. The DOM recording sell off on one of the days. Let's take an example of the hunter liquidity. As you can see here, look at this. Look at this chart over here, this ladder. As you can see, we see here on the NASDAQ, there is a liquidity of 104. That's a liquidity. The question is this guy a prey or a hunter? If it's a hunter, he will push the price down and buyers will not be able to buy him out. So from the behavior, you can see there is a rejection over here at this price. I see a big liquidity, so I have to identify now. In this case, if you have values below, if you have a setup complete, you can take short and protect your stop loss behind this liquidity. Pay attention here how the price will react to this liquidity. See, there is a rejection and the price here cannot push through this liquidity. So what's the expectation? That this liquidity, this seller probably will push the market down. As you can see, you see what happened here? He probably have way more size than you've seen on the ladder here. Why? Because this is what his hand showing, but probably he's hiding a lot more size to execute as a market order, not as a limit. These guys don't want to expose their hand. So they show a little bit on the limit order and they use the rest of execution as a market order and they take the liquidity from the buy. You see how much liquidity here on the buy side, but still the hunter keeps showing big liquidity on the sell and pushes the market down. That's a behavior of a hunter. And if we wait a little bit more, you will see the big size coming back again and pushing the market down, as you can see here. This was a very strong downtrend. The indication was a hunter seller that was controlling this sell process. As you can see, pushing markets down and he's taking the opposite liquidity. So we have to have a visual of who's controlling the market, who's taking the liquidity out of the market. And in our case here, it's the seller that we've seen pushing the market down. Another example, looking at the walls. This is another example here. We will be looking at the market interaction with the wall. So I have my levels set up here. I have my X pattern, V1, V2, V3, V4, and I have a hidden value here in between. I identify later. So right now I have a direction for the market to push. It's pushing towards the hidden value. Okay, now we're at the hidden value. One of our rules, do not trade in the value range. You have to wait for the market to push away from value, and then we take the setup trade all the way back to the value again. As you can see here, the market is reaching a high, creating 1, 2, almost 3 hits over here. And as I can see, there is a rejection for this value above. Market is not willing to reach this value. Market is actually showing some resistance over here from this. So I start to take my execution towards the hidden value. I have 3 heads. I have a rejection towards this value. So market expectation is go back to the fresh hidden value. We have 2 targets on the way, which is V3 from the X pattern and the hidden value over here. I spot my volume profile earlier, but now the focus is not the setup. The focus is the ladder. I put my stop loss above the 3rd head. I took my entry at the 60. Actually, I could have taken a better entry at the 61, as we spoke earlier about the round numbers. So that's a mistake over here. I should have had my entry at 61 to give me a couple of ticks in my favor. As you can see, these couple of ticks worth $30 on the Nasdaq on one contract. So it's better to keep those in your favor if you can catch the short from above the round number. So I took the short. And now I see a wall here, 2 and 3. It's not clear out yet, but I can see that there is a liquid price over here that is acting like a wall, 2 and 2. That's a wall. And now the market coming in my favor. As you can see, the other type of wall, just so. You see the wall over here, 2, 11, 1. That is a wall. So that is a reasonable place to protect your stop loss. You see how many walls? 1 and 2. Right now I have my stop losses as a market order and the market moving now in my favor. You see a wall over here, 2 and 2, but it just faded away. Market pushing in my favor. So I'm taking 2 contracts and now I'm trying to scale out of my trade with 1 contract, as I spoke earlier, profit management, where you have to take one contract profit on the way to take some profit and cover the risk on the trade. And the second contract will stay till we get to our targets. And as you can see here, I'm moving my scalping order, the first one, I'm moving behind the wall in my way, just to take the best exit on my profit. So I can see here, there is a huge LBN. It's not a clear wall yet. I can anticipate those from experience, but if you first experiencing this, you better wait to see a wall before you moving your order. Now the market is pushing in my favor. I have two contracts still. I'm moving behind this wall over here. As you can see, the two, it's not a visual wall yet. Two contracts, this range worth of a 175. I set my first exit here at profit, and I moved my initial orders to break even because we already reached the first target and we reached the second target. And now what I am doing, I don't take profit or I exit the market by myself. Maybe the market will continue 3 times bigger than this range we have. We don't know. We don't know how far the market will push. But what we know, once the market gets to our profit target, we have to lock our profit. So we guarantee our profit, but at the same time, I open the door for the market to reward me even more on my trade. You never know how far the market will go in your favor. So don't kill your trade yourself. Don't hang yourself out the trade. The market is unlimited money. So open the door for profit. As long as you can lock your profit on the way, open the door for more profit. Don't go and just kill the trade by yourself. Use the information on the ladder to maximize your profit and let the price slide more in your favor. As long as you can move these stop losses behind walls, you can maximize as much as you can on your profit targets. See, I'm moving my orders now behind the walls. So I'm locking my profit. At the same time, I'm opening the door for more profit. See, I moved my second order here behind another wall. I'm moving my 2 orders because we hit my both targets on the trade. And let the market take you out of the trade. Don't do it yourself. Let the market behave. As long as you're interacting correctly with the ladder, let the market do the job for you. Don't take yourself out of the trade. I moved my stop loss order. Now I'm below. So the worst case scenario is I'm finishing taking out this profit in my favor, because now these are my stop losses in my favor of shorting this trade. It's no longer against me. So I'm protected from both ways. So now you need to relax and stick with the ladder information offered. Walls and liquidity. As you can see, a big wall over here. Have you seen these triple ones? This is a huge wall. You can use it also in your favor. And for such a strong wall, I should have actually moved my both orders over here, because that's a strong wall, and I should not stay longer in the trade if this wall gets broken to the upside. You see the wall over here, very strong, and tends to prevent the market from going up. So market's still in my favor, and I'm still moving my stop losses to maximize as much as I can. So right now, I'm not sure how far the market will go, but what I know, I can react to these prices over here till the market decides. You see this 3-3, it was a wall over here, another wall showing up at the 54. The market's still in my favor. Why? I can see that through the walls on the ladder. Very important to see the walls and the liquidity. Liquidity down here represents 8. That seems like it's holding the market since we have a value here, acceptance. So expectation here from V4 to the hidden value again, but we still with the trade. Don't exit yourself, let the market take you out. These walls might hold the market for long and push even further. You see how reading the market is easy and smooth when you get the direction and the levels on your chart, and then you get the execution on the ladder. I know it's a lot of work, but with some practice and screen time, this all comes like a muscle memory, and it took me out of the trade. So these are the two examples to elaborate on what we discussed. So for summary, we have to watch the round number to take entry at the best price. We have to watch for walls, which represents like this, which is represented like these two shapes, LVNs, and here also 2 types of walls. And also we have to keep an eye on the liquidity. And from the market behavior, we have to decide if this guy is a hunter or a prey, push the market in our favor, or be a liquidity that the market will hunt.